Homework 9, we were basically doing the Facebook assignment, and the first part of it would have been doing an as-is valuation as of about July 24th, before the bad news conference call on July 25th. So that would have involved a little bit more of a challenge in Bloomberg. So the first thing you should have probably done is in Excel, go to Facebook. You should have gone to FA, custom, gone to our model export tab for Facebook, whatever you had called it, export, Excel, template, and you should have basically gotten a file that looked something like this. Make sure you replace the dashes with zeros, and then you should have copy and pasted it into what became your as-is valuation file here. Okay. Then you would have gone to the assumption screen. As of July, we'd still be in the 2017 historical year data as the last full year, so that wouldn't have changed. We then would have had to put in a WACC. Now, again, a little tricky because we're using historical data, but one way you could have done the WACC is if you've gone to Facebook and typed in WACC, then you could have gone to the history and essentially switch this to quarterly, and these would have been historical quarterly WACCs. 11.52% would have been June 2018. Or what somebody said they did is they actually looked at the graph and they tried to basically just put their pointer on the graph and guesstimate where it was, but they still came in around 11.5%. But that's the idea. We needed a WACC, ideally somewhere around 11.5-ish, I'll call it percent, around the time of our valuation. Okay. Ideally, it would have been the WACC on that day, right? But 11.5 would probably be close enough. Anybody do something different? Okay, so we got the WACC. Next, we need a share count. So the simplest way to do this would have been to go to, again, FA, custom, create a custom one, shares, and go to the current shares outstanding. And again, if we switch this to a quarterly basis, this would have been the share count as of June 30th, 2018. So you probably would have used this one, although that technically wouldn't have been the one to use. And here's why I say, because that share count would have come from a 10Q, and the 10Q wouldn't have been released until the following day. So we wouldn't have the second quarter share count on July 24th because we wouldn't have seen that 10Q on July 24th. We would have had the first quarter 10Q, which would have been 23.95.92. Okay, so I think almost everybody in the previous couple sections used the 23.98.61, but frankly in Bloomberg, that data point wouldn't have been there for about 24 more hours. So the data point we would have seen in Bloomberg at the time was 23.95.92. The good news is the amount of shares between those two quarters is pretty trivial as a percentage of total shares. So using either share count is not going to really affect this exercise. And since most people use the 23.98.61, I'll use that in this simple solution file. But technically, we probably would have been better off using 23.95.92 because we wouldn't have seen this data point as of that day just because of the releasing timing of the Q. Make sense? Questions about that? I assume everybody here used 23.98.61? Yeah. So I'm not going to hold that against you, but technically you wouldn't have seen that data point on that day. You would have seen this one. Okay, so let's use 23.98.61 because most people did. And as I said, it's not going to really affect things. So then we had to figure out the share price of that day. Simple way to do this is you could have gone to the graph price. You could have changed your price range to July 24th, and that would have been the closing price in July 24th, 214.67. I'm sure there's other ways to get it, That was just a simple way of getting it as of that day. But that's the key. We needed a price in that day. About $214.67 was the closing price on that day. $214.67. All right. These were all pretty trivial. Now came the more challenging part, which is the consensus estimates. All right, and this one was just tougher. And then again, part of the assignment, problem solving in Bloomberg, is what we really needed is not just the consensus estimate, but we needed a forward estimate as of, we needed a consensus estimate as of a specific day. So that was trickier. So let's go back here. So here, we had to go to the RV section. You can't do this in FA. Or you could do it in EQS, but RV would have been helpful. Go to custom. And this is where you'd have to get into best, which is the Bloomberg Consensus Estimate database. And we'll start out with best sales. You'd go down to estimate revision. And what you'd want on an exact date, you'd want a single value, the date being July the 24th. We wanted the yearly data. Now, this is, again, another tricky part because our nomenclature is a little different. We've been talking about Y plus 1, Y plus 2. Our forward year 1, forward year 2 is what I'm saying. But Bloomberg on this screen is calling the current year, not forward year 1. They're just calling it Y. And they're calling next year, which we were calling the FY2, they're calling it the Y plus 1. Okay, so you'd have to kind of look and see what it's saying over here on the right, the words, because it's not as consistent throughout the database. So again, this would be 2018, 2019, 2020 sales forecast on that date. So we'll start with 18. Same thing, best sales, estimate revision, yearly, next year, 2019, I want a single value. I want it on that day. So on that day, July 24th, 2019, sales estimate 72,470. Repeat this process 4 more times for the 2020 sales and then 2018, 19, and 20 EBITDA. Okay, so I just created this little save template here. Discard. So basically what you would have done is just repeat the process for best sales 18, 19, 20, EBITDA 18, 19, 20. In addition, you would need the EBIT for 2019, next year's EBIT. Same idea, best next year's EBIT is at that date. And then you're eventually going to need an enterprise value. So here was the enterprise value. So you would have used periodic enterprise value. Add a column here. As of a customized period, exact date, and again, give me the enterprise value as of July 24th, and that would have given me that number, 579,310. And again, I know some people were confused by this last week, but enterprise value is not really a forecast. It's like stock price. It's just the value as of that day. Okay, so we just needed the historical enterprise value. Okay, and we're going to need that to do an EV to sales and EV to EBIT multiple in just a second. All right, so that would have been probably the tougher part of the assignment, which is basically just kind of pulling historical data from the Bloomberg historical database. So questions about any of those numbers? Where I got them? How I got them? What they mean? All right, so as a next step, you'd have come in here and basically put in the 3 years of sales and EBITDA estimates. You'd have come over to ratios, and the next thing you would have needed was a tax rate. Now, again, here, you would have to go to the EVT screen. So go back here. So again, I'm going to cheat. Go to the transcript analyzer, which you don't have access to. And for Facebook, single security, do a search for the tax rate. And so in the conference calls, the short answer was in the second quarter earnings call, which occurred on July 25th, which we didn't hear yet, they said 13%. In the first quarter call, they said it was 11%. Okay. So here's the thing. Some people use 13, but again, technically you wouldn't have heard the word 13, you would have heard 11. So you should probably use 11. Although from a valuation standpoint, 13 actually seemed to work better. So I'm not going to hold it against you if you use 11 to 13, but you're going to probably use at least one of those two numbers, 11 or 13. Anybody use a different number or get a different number? For tax rate.
Yeah, I used like 17.
Where'd you get 17 from?
So I remember reading on their transcript that it would be like mixed.
Which transcript?
The latest, like Q3.
Well, there's the problem. See, the one challenge, and this is just a challenge of this assignment, is we got to be careful, since I'm using sort of the data on July 24th, that I wouldn't have heard that number yet. So that's the one challenge with this assignment. I'm not saying it's easy, but that's what I said. Same thing with the share count. Like, even though it's the June 30th share count, we wouldn't have gotten that data point on July 24th because that data wasn't released until July 25th. So same thing with the tax rate. Like, we wouldn't have heard them use the number for that tax rate call until September. And we're trying to do the July view. The world has changed. So 11 or 13 were the two numbers they were talking about. Actually, 11 was the number they were talking about in March, April, versus the 13 didn't get talked about until after July. But at least it was close to July. 17 would have been the one they're talking about now. Too close. All right, so back to this. So I'm going to use 11 initially, but I'll probably change it back to 13. I got to make sure that I don't have any lingering effects here in my as is. So just kind of carry over the growth and the margins. Okay, so here's the deal. I got to do the tax. Next, I need to estimate my margin. Well, that's the point here. If I take EV to sales and EV to EBIT, I get my margin. So I need an EV to sales. So on that date, the enterprise value, and you can see it up here, is 579.31. And the sales as of that date was 72,470. So if I take the enterprise value divided by these next year's sales, the EV to next year's sales, forward sales, would basically be 7.99. And the EV to EBIT would have been 17.33. Okay, so basically that would have been, that's why I got EV to EBIT off of the RV screen. So the EV divided by the forward EBIT, 17.33. EV divided by forward sales, 7.99. So if I divide the two, the market was actually expecting a 46% operating margin based on those trading multiples. So what's interesting is even though the market had expected Facebook's margins for the next couple of years to surge, they actually did expect it to come down even before they got the bad news from the CFO. Okay, so it wasn't like the market was completely surprised by the drop in margins because the trading multiples had already suggested that the market expected higher costs on that day associated with Facebook's expenditures for the future. So essentially, to get down to 46, this would have to be something like, was it 50, 55? No, 53.5. So they already expected a big drop into EBITDA margins closer to where they were in 2016. All right. Now, to get to the current share price, I'm probably going to have to drop that based on what I did earlier, closer to this number, so call it 54. And that growth rates are going to have to be around which further suggests that I probably need to use a 13% tax rate, not an 11% tax rate. So I'm now getting closer to the current share price. And oh, by the way, I forgot, I got to match my G's. And to get my G, I'm probably going to need a G closer to model 1632 versus 17.33. So this is going to have to be like 7. But that's going to basically cause my share price to be off by $6. So what it really says is somewhere in here, getting close, that Facebook was already expecting at this time a big slowdown in their growth. That the market was already questioning the growth rates, and the market was already questioning their spend and their margins even before the bad news of the conference call. And then it's like the hammer dropped. It got even far worse than what the market expected it to be. So this is where we would have gotten about in the as is, right? And then we would have had to do what I called the incremental step. And this is what, again, a lot of people got confused by, so I just want to be really clear that what I wanted you to do was basically this. These were just basically copying off of the assumptions tab. These were these 6 numbers, okay, in our as-is as of the 24th. So I put this here. Those are those 6 numbers. Then I want you to go to the transcript. So if I go to the transcript, EVT, for Facebook, and I go to the second quarter conference call transcript, right here. Now I'm just reading the transcript. So listen to the call just like an analyst, half paying attention. We're wonderful, we're great, you love us, we're your overlords. Aren't you excited about the Facebook portal? Now we can actually look on you and your whole life and video and see everything you do, as opposed to tell everything you do. Don't worry, we won't use your private data except to monetize. You give us permission because you like that, right? So basically, we're just going to make a ton of money off of you. Our customers love us. Oh, by the way, everything is rosy, everything is fine. And then the CFO gets on. And basically what the angel of death says, that wakes up the analysts who are barely paying attention anymore. Where is this? Turning now to expenses. We continue to expect that full year 2018 expenses will grow in the range of 50 to 60% compared to last year. Yikes. What? What did he just say that? And then blah, blah, blah. Looking beyond, we anticipate that total expense growth will exceed revenue growth in 2019. Over the next several years, we would anticipate that our operating margins will trend towards the mid-30s on a percentage basis. And we're going to spend $15 billion in CapEx. Oh, shit. What just happened here? Okay, so we're basically just told that our operating margins are plunging to the mid-30s. And right before that, he gave revenue guidance that says, turning now to our revenue outlook, our revenue growth rate decelerated approximately 7 percentage points in Q2. Our revenue growth rates will continue to decelerate in the second half of 2018. We expect the rates to decline high single digits from the prior quarter sequentially in Q3 and Q4. So basically, if you take 1.07 to the third power, they're talking about 22% drops in revenue this year and margins going from mid 40s to mid 30s. Okay, that is what precipitated the big drop in the share price. So how do we model that? So coming back to, oh, by the way, this is funny. So the transcript, now you're in the Q&A, and then somewhere in the Q&A, basically, Ross Sandler from Barclays says, "Can you guys hear me?" CFO, "Yes, we can hear you." "Okay, sorry, Dave. Blah, blah, blah. I think you said quarter-on-quarter growth rates are going to be high single digits lower than prior quarter-on-quarter growth rates. That would imply around a 20% year-on-year growth rate exiting the fourth quarter. So you just want to clarify, is that what you actually said? Like, I don't believe I heard my ears correctly. Is that, if so, what's going to drive this dramatic deceleration of growth?" And so the answer is, yes, it's exactly what we said, and it's currency and other stuff, and GDPR. So basically, we can't rob your privacy as much as we did, thanks to those crazy Europeans who are protecting consumers on their behalf because consumers aren't protecting themselves, and we're going to spend a whole lot more money to comply. So long story short, we also can't advertise as much and sell their data as much without their permission. So yes, you heard us correctly. So let's go back. How do we model that? Well, first thing, 1.07 to the third power is 22%. So either 20% or 22%, somewhere in that range, is what the CFO said. So if I take these revenue estimates, I'll be conservative, and I knock them down by 80%, then that's basically slowing down the growth by 20% a year. So they're still growing. They're just not growing at quite the same rate. So 45, 58, 71 versus 57, 72, 88. Okay. Then in our as is, before we made any changes, operating margins is what he's talking about, is operating income. Right now is mid 50s, and he said it's going to get down to what? Mid 40s? Mid 30s. Sorry, it's going to get down to 35. Mid 30s, we're going to call 35. Okay? So here's the point. Right now it's 53.6. He says it's going to get down to 35. That number. Not the EBITDA, but the operating margin. That's a big drop. By the way, they were there in 2013. It's basically saying we're going to 2013 levels. So here's the deal. Here's how I did this. What I did is I said, okay, take the 34.7 and multiply it by 0.35 divided by 0.536. So even though that's EBITDA, what I'm saying is the same percentage drop that they're getting in their EBIT should be the same percentage drop they're getting in their EBITDA. Okay, so I'm kind of holding depreciation's also going down. Now, technically, it could be a little worse because basically, if EBIT isn't going down, then they'd actually have, depreciation isn't going down at the same rate because they're actually spending more CapEx. It could actually impact them a little bit more. But the point is, if they go in concert with each other, EBITDA should go down by about that percentage amount. So here's my new EBITDAs at the same lower margin. So now I'm getting EBITDA margins closer to 50%. So I take these 6 numbers, copy, paste, copy, paste special values, and if I don't change anything else, 169. So somewhere in the 160s. And by the way, on that date, They went to 176. So the whole point of the final part of the essay is not over. They're probably going lower than the 176. And by the way, hindsight being 2020, today they're at 143. So to some degree, the market had not completely priced in the really bad news that Facebook had communicated. That the lower growth rate and the spending that caused them to go back to 2013 margins was really going to have a dramatic effect. And again, wiped out over 100 billion, and 100 billion wasn't enough. And it wasn't that they were losing money, it's just all that upside that people thought they were going to have wasn't going to materialize. And that's the pain that they continue to face today. But nonetheless, we had to try and model this. And that's the thing. On July 25th, we're scrambling. That night, there's a lot of people burning a lot of midnight oil trying to do exactly what you were doing to figure out what do they tell their clients in the morning now that we've heard this call. So that was the exercise. Questions? Yes?
I have a general question.
Mm-hmm.
So the transcript call happened at 5 o'clock on the 25th?
I need to check the time, but I think so. Let's go back and look while you're asking that.
So is there a reason why we did the as is for the 24th instead of the 25th? Since the call
that's a great question. Technically, we probably should have done it on the 25th. What I was worried about when I did the assignment is I didn't know what time they'd actually released their numbers that day. Meaning, even if the call was at maybe they released it at 4:01 and the call was at 5, but when I was creating the assignment, I just didn't know. And I didn't want to take the chance that the call, the numbers had come out the morning of, because I just didn't know. I hadn't looked at Bloomberg. So the short answer is, if it really came out the end of the day, then yes, we should have done the January 25th date. But the reason I chose the 24th is I just didn't know when I created the assignment what time on the 25th it was released, and I just knew that day was going to be crazy. So I just did the day before, and I didn't think it was going to matter that much. If you did it as the 25th, and the transcript came out later that day, I don't think it matters. Or the earnings release came out later that day. It doesn't matter.
The numbers came out the same.
They're going to come up pretty close. And as I said, that's why I said, even as you go through this, you could have reasonably made slightly different assumptions on margin, because he said mid-30s. I'm using 35. You could have said 34, 36. I can't fault you for that because he said mid-30s. Same thing with the revenue growth rate. He said high single digits. He didn't say 7%. So you could have actually used a slightly more aggressive decline, slightly less aggressive decline, and how you interpreted mid-single digits. So again, it's more the range, and at least are you picking up how to model some of these things that was more important to me. Okay? But good points. Other questions? All right, that was homework done. All right, again, a little bit more of a challenge, because as I said, unlike previous assignments, this wasn't just cookie cutter. This isn't just look up a number and put it in. You had to really think through this one and make some interpretations, which in a way is much more real world. There's a lot of shades of gray in the real world. Okay? All right, so let's talk about homework 10 and an adjustment to your final group projects this semester. So I'll just go ahead and start the process. Here's the template that you're going to have to create in Bloomberg. Okay? Because what we're going to do, and this is the last change we're going to make to our model before the final version, before your final projects are due, because I want to lock it down and give you the time to not change things on you the day before the project. But it's what's called a sanity check. Okay? And this only applies not to the as is, but it only applies to your bull, your bear, and your target. And it only applies to your target if you don't do a hold. Okay? So here's the thing. If I come up with a share price that's far different than the current share price, how do I know it's reasonable? If I come up with a share price that's close to the current share price, by definition it's reasonable because people are already paying that price. But if I'm way off from that current share price, I can't say with 100% certainty that I'm right. So how do I know that I'm being reasonable? And that's what I'm going to call the sanity check. and we're going to use multiples to help us understand the sanity check. Right? Now, I had previously done this in the last section, so I'm going to show you the answer, and I'm going to show you how we back into this answer. Okay? But here's the idea. Let's just say I go crazy, and I'm just like, all right, I think the market's got Facebook wrong. They just do not understand the power of this company, and people just don't care about their privacy. And the governments at the end of the day are just not going to regulate this, and Facebook is going to monetize the hell out of this. The market's got it wrong. So I start putting in crazy assumptions. To me, they sound reasonable. That Facebook's going to start growing 20% a year, and their EBITDA margin's going to zoom close to 70%, which, by the way, is going to give me a share price of $258 a share. Buy. Okay. Now here's the thing. At a $258 target share price, that would imply an EV to sales multiple of 10. A $258 target share price for Facebook, I would have to pay 9.99 times next year's sales to equal that share price. So I'm paying 10 times sales. This is the trading multiples of EV to sales today for all these companies. Does that look reasonable? There is nobody in this industry that people are paying 10 times sales for, right? So what I'm just telling you is, as much as I can talk myself into that I believe that somebody's going to pay $250 share price, there's no multiple that sounds reasonable that I'm going to tell an average fund manager to pay 10 times sales when no one in this industry is close to 6 or 7 times sales higher than that. Why would I suddenly pay 10 overnight? Something would fundamentally have to change. I'm not saying it's not potentially probable, but it's almost physically impossible. And so therefore, I've just gotten way ahead of myself. And that's the problem with these models, is you start making incremental assumptions, and the cumulative effect, you don't realize how big a change you're actually making. And what seems reasonable actually starts getting unreasonable. So how do you rein yourself in? Same thing. At a $250 share price, I'm paying 20.4 times EBITDA. Well, the industry average is 12, and Tencent, which is one of the strongest valuations, is at 16. Now, there's this teeny tiny startup over here that's at 31, but Facebook isn't a teeny tiny startup. So I'm not sure 20 times EBITDA or 24 times EBIT or a PE of 30 is the right answer. And so that's the idea of what I'm calling a sanity check. So what we're going to do is we're going to use the multiples in two ways. Multiple analysis is one section of your project, but as part of the fourth part of your project, the valuation, we're going to use the multiples to do a sanity check to make sure that we're being reasonable with our bull and our bear. Because the same thing, even calling this the bull range, there's no bull range that's going to get this high, not in the next 12 months. So I can't even say that this is a reasonable bull, much less a target, because this is just too crazy. So it's just a way of help reinforcing kind of a dose of reality into our assumptions. That's what we're trying to do with the sanity check. Everybody clear on what I'm trying to do? What you're going to be doing? And by the way, you're going to practice this with homework 10. Okay? So with homework 10, what you're going to do is I'm going to give you a company, it won't be Facebook, and you're going to basically have to do your bull and your bear and a target, but as part of that, you're going to have to write up the sanity check. And the sanity check is, why is my bull reasonable? Why is my bear reasonable? So don't just come up with a bull and a bear, but then validate it against actual multiples in the real world to say why it's reasonable, and then iterate. Okay? That's what we're going to go with this. But let me come back. So how did I get this template here? So here's the first thing. To get a forward EV to sales, these numbers, these four numbers, EV to EBITDA, EV to EBIT, PE, I need to create a template in Bloomberg. So off the Facebook or any other stock, RV, custom, create template, add column. What's my first column? EV space TO space sales, EV divided by sales, EV space 2 sales. And you'll notice that Bloomberg already has a Bloomberg field called EV to next year's estimated sales. This is a pretty common used multiple, so Bloomberg already has it pretty much defined. Now, I could create this as well by going EV to best sales and adjusting it to next year and get the same answer. But for simplicity, I'm going to use EV to next year's sales. Same process. EV to EBITDA. And if I don't see it on here, I can show more matches. Scroll down. But then I have EV to next year estimated EBITDA. And next year is basically 2000 and for Facebook, 2019. And then finally, EV to EBIT. And same thing, if I don't see it on here, show more matches. And I want next year's, oh, gotta spell correctly to get it. EBIT, not EVIT. EV to next year estimated EBIT. And then finally, I want my PE, and I want my PE for next year. So save this as a template. UMD. So I can use it for any company that I have. Okay, so these are the multiples that I'm going to essentially get my industry multiples, industry average, and my range to use as my test against the variables in my model for reasonableness. So here's how I'm going to adjust my model. I'm going to take this template and export it to Excel. So once I have this in Excel, I'll start with my Facebook valuation model, or whatever model you happen to want to put this in. It'll be the one that you'll use going forward. And what I'll do is I'll come in here to the exported spreadsheet. I'll right-click on the worksheet. I'll move or copy. I'll go to my valuation model. Actually, my final one. Create a instead of don't create a copy, I'll just move it. Move to end. Hit OK. And basically, this is now the last tab in my model. Okay. Now I'm going to rename this multiples. Now I'd already put this in there in the last class, so I'm going to do the same process. So I'm just going to call this multiples 1, but it's basically the multiples template that we put in. Well, let me have the same name. Multiples. Okay. And I'm going to also move this down one row so that my model multiple, or what I'll call the implied multiple, I'm going to put the 4 multiples that the model calculates right here. I have my actual values here. When I do a new company, I can just copy and paste whatever template for whatever industry it is right below, and I can quickly use this to help me. I can do some of my multiple analysis off of here, but more importantly, I use this as my sanity check, and I put it right into my model to do so. Okay, so now I just need to put these 4 multiples here. But here's the other rub, and it's a definitional question. When we go back to Bloomberg, go to FA. This is Bloomberg's definition right here of enterprise values, how Bloomberg calculates enterprise value. And what you'll quickly notice is the way Bloomberg calculates enterprise value is not the way we're doing it in class. We're using Modigliani-Miller's enterprise value definition. Bloomberg is not. So it's an apple and an orange. So it's not completely comparable. Our model's enterprise value is not the same as the real world enterprise value. They made adjustments. So here's the last step. In our model, in our valuation tab, we're going to create next to our enterprise value something called the BEV, which is the Bloomberg enterprise value equivalent, so that when we do the multiples, we're using an apples and apples calculation for enterprise value. Okay? Now here's the thing. Why is it different? It's not a question of right or wrong. It's different. But here's the thing. When the academics got together with Wall Street and Michael Bloomberg in the 80s, it was a simpler time. It just was for financial statements. And so when they originally developed the formulas, as an example, companies didn't have a lot of non-operating assets. They just didn't. All right, it's just a different world today than it was 30, 40 years ago. So here's the deal. When they did the definition, look at our definition here, they did enterprise value, the debt and equity. Well, if you look at Bloomberg, what are they really doing? Total debt, which is interest-bearing debt, short and long term, preferred stock and minority interest, and market cap, which is the value of equity. Let's look at our definition. Minority interest, preferred stock, interest-bearing debt. You know what you don't see here? Retirement-related liabilities. They're not putting retirement-related liabilities in the debt side. I'm not saying it's right or wrong. They just didn't. So we're including it. They're not. We don't have the same enterprise value. So the first thing we're going to do is we're going to take our enterprise value. We're going to subtract out the retirement-related liabilities just to be consistent with their definition. Okay? Now, here's the other thing. They then subtract all cash. Right? So if you think about it conceptually, enterprise value minus cash is pretty close to what we would call operating value. So the Bloomberg definition and the academic definition that's taught in most business schools is closer to what Modigliani-Miller would call the operating value of the firm. And the non-operating asset that's being excluded is cash. Because back in the 80s, cash was the primary non-operating asset. The other stuff was pretty insignificant. So it was just pretty simple to do that as your rule of thumb. So debt plus equity minus cash, or what they started calling net debt, debt minus cash plus equity, is enterprise value. And that equals your assets, minus cash already taken out. That's your assets. Those are the assets that you use to actually make your business. They didn't distinguish non-operating assets, right? Academically, if we want to be fine-tooth, we could poke holes in this. But it's the way the world works. This is what's being used in the real world. So what I'm just doing is I want to put the equivalent in here. Now here's the other thing. Bloomberg's not separating out excess and operating cash. They just subtract all cash. Again, it's not a question of right or wrong. I'm just going to follow the model. So my second adjustment, after I take out minus retirement, minus operating cash, minus excess cash. So I went to the balance sheet, G4, and I subtracted out both. Now, we made a big deal early in the semester, including in the video, that you can't take out the operating cash. You shouldn't, because you could never pay it out. But in the real world, people don't make that distinction. So just to be consistent with that enterprise value, we're going to use the real world definition here. So we got the clean definition, and we got the Bloomberg definition side by side. Notice that when we do it, even for Facebook, you can see on the valuation tab, there's about a $40 billion difference. So it can be substantial, right? So now how do we do a multiple? So EV to sales equals the Bloomberg EV divided by, and I'll go off the income statement, second year 2019 sales, I3, EV to EBITDA equals the Bloomberg EV divided by, take it off the income statement, 2019 EBITDA, EV to EBIT equals the Bloomberg EV divided by the income statement, 2019 EBIT, which we're calling operating income in the model. And finally, we need a PE. If we take out share count off the valuation, it is the common equity value divided by 2019 net income available to common shareholders. So there are the four multiples created by our model. There are the Bloomberg multiples and the industry and the range. That's the final step to the model that we need. After this, we're not making more changes to the model this semester, but you'll need this to do homework 10, probably homework 11, and also to do your group projects. So the person that's doing the valuation section of your group project, this is the addition to what they have to do. Right? When they do the bull and the bear, they have to mention as part of their bull and the bear why the bull and the bear are a reasonable bull and the bear given the multiples. Okay? And there's no hard and fast answers to what's reasonable. It's kind of it's like the original Supreme Court definition of pornography. You know it when you see it. Okay? Like you'll know it when you see this number, you know that this is unreasonable. I can't tell you that when you get to 8.01 versus 8.0, that's the dividing line. Like it's a reasonableness test. It's not an absolute test, right? But nonetheless, that's what you're gonna have to do for the bull and the bear. And if you have a target stock price that's not a hold, then you also have to do the reasonableness test. So if you do a buy or sell, same idea. I think it's a sell, and I think this sell is a reasonable sell for this reason. All right, questions? Yes.
Would we come across similar numbers if we made like custom Bloomberg fields where we did our version of EV over the sales and we did those types of multiples?
If you wanted to create a custom EV in Bloomberg, you could potentially do the same thing. But you'd have to create a custom version of EV in Bloomberg. All right. Actually, take it back. I don't think you can. Now that I'm thinking about it, I don't think you can because our EV is a forecast. That's the problem. So I take back what I said. No, you can't do it in Bloomberg because what we're doing here is we're basically saying our forecast is creating a multiple based on that forecast. And is that forecasted multiple reasonable? So you really can't do this in Bloomberg, unfortunately. You have to do it in the model. Or a separate model, but I'd like to put it in this model, make your life a little bit easier. All right, good question. Other questions? Okay, so as I said, this is going to be part of homework 10. So the Thanksgiving holiday is coming up next week. The 11 a.m. section asked me to do something nice. The 12:30 section said that they don't want me to be nice. So I have to think about this. And what I mean by this is I was going to basically say, all right, just to be clear, homework group project 3 is due on Friday, 5 p.m., all sections. That's not changing. Got to finish that. That's the market analysis for denim versus athleisure, right? For Monday, what I was going to do is I was going to make homework 10 an in-class assignment on Monday. And the 11 a.m. section unanimously, can't talk today, agreed. They thought that was a great idea. The 12:30 section thought it was a horrible idea because some people apparently want to have an early Thanksgiving and they don't want to have to come to class to do an in-class assignment. They'd rather do the homework assignment. So I think I'm going to probably have it be both. Some way that you can either do it in or out of class, but generally favoring the people that do it in class. So regardless, it's not going to be due on Monday. I'll say that because I don't want to have another assignment given you guys got a lot of work to do on a 1,500 word paper. So I'm not going to make it due on Monday before class. It'll be due maybe after class, and we'll give you class time to work on it on Monday, but also give people that aren't going to be here a chance to work on it on Monday I will figure out what those logistics are, right? But there's no assignment technically due Monday before class. The assignment will be due after class, and you'll have time to work on it on Monday. Okay, does that make sense? And then what I'm going to also do is so that, and this, the previous two sections unanimously agreed upon, I decided not to give you a homework 11, the final assignment, during the Thanksgiving break. So that will be done sometime the week after Thanksgiving, so you can have at least 4 days of rest, respite, and not have to worry about this. Unless anybody here objects to that one. I thought that one would be more palatable to everybody. I actually thought both would be beneficial until they're like, no, we don't want to have to come to class. But in any event. So I'm going to make those accommodations. Those will be put up on Elms. And yes, sir?
So for homework 10, I know you said you're still figuring out the logistics. When you say due at the end of class, do you mean
like 5 o'clock?
Or at the end of the day?
No, end of the day. It's going to be something like a 5 or 6 o'clock deadline on Monday. Because to be honest with you, I'm not grading anything on Wednesday. So I'm going to take advantage of the university holiday on Wednesday myself. So I don't plan on grading anything or looking at anything on Wednesday unless I absolutely have to. And I don't really want to have to. All right. So hopefully that's all clear. Everybody, if you have any questions about your group project, see me before you leave. Otherwise, we'll discuss that as well on Monday. Have a good weekend. Just, sorry, I recorded this. I want to get the recording in before. This is November 14th. Let's see.